Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending April 5th, 2024. I'm Preston Brent, and thanks for tuning in. Well, the week's theme is pretty simple, bulls versus bears. Right now, the bulls have been just kicking butt this year, but the bears are right around the corner. Let's take a look at how we did this past week and just kind of take a look and get my take on some of the charts and what I'm seeing here. You can see everybody was in the red this week, although it didn't have that down week feeling, certainly given the strong close that we had on Friday. But you can see the Dow was down about 2.2%. S&P, NASDAQ, Russell all down. Russell down a pretty good little bit, but year to date they're all in the red. S&P up 9.11%, NASDAQ 824. You can see here that this past week energy stocks did really well for the week. All right, and gold also. Gold and energy hitting highs. I think energy is highest level since October. Gold highest for several years. We've had a breakout from about a 3-year sideways pattern. I'll show you that in just 1 minute. PE ratio, you can see the Ford PE is at 21.10, so it's been reduced a little over 8, almost 9% from the trailing 12-month ratio. So valuations are starting to come in just a little bit. Dividend yield 139, 10-year Treasury finished at the high for the week, 4.38. I mean, we got the ISM services report that was released midweek on Wednesday, and it's still indicating expansion. All right. Friday's jobs reports came in very strong, 303,000 jobs. Keep in mind, 23% of them were government jobs, and there was a ton of part-time work. All right. So that's kind of clouding some of this. Although the unemployment rate, it ticked down from 3.9 last month to 3.8% in the month of March, right? And what really goosed the markets were wages. They came in with just a small increase in the average hourly rate, okay? 4.1% annually year over year. That's the smallest gain we've seen since June of 2021. So that helped the markets. It kind of gave you almost like a Goldilocks kind of jobs report, right? Part of the reason we may have seen a solid rise in labor participation also, that's kind of suggesting that employers might be enjoying an easier time filling empty slots, all right? But the yield on the 10-year, as I said, it jumped on the news and it closed out the week at 4.38. That's the highest we've seen since November, okay? You can see the VIX up for the week. It closed the prior week at 1306, this week 1603. So it was a big, almost 23% jump, 23% jump in the VIX week over week. So we're starting to see a little bit of fear come back into the market. All right. One of the things that put some fear in the markets this week was we had like 7 or 8 Fed governors speaking. Several of them came out and said they're going to be very slow in hiking rates. One of them said, I don't even see a rate hike at all, or rate cut at all this year. In fact, a rate hike could be in order if inflation doesn't come down. Well, all that does is just add volatility to the markets, and we saw it on Thursday when the markets had a hard down day. We recovered some of it, but not all of it on Friday, which gave us that down week for the week. All right. You could see the best performer for the week is energy. Year to date, it's up almost 18%. Okay. Worst performer is healthcare, and real estate year to date down 3.54%, being the worst performer. Okay. And then, of course, if we look over across the pond, we look at Europe. Everybody is pretty much in the red there too, from Eurostoxx, FTSE, CAC 40, DAX, all in the red. Year to date, they're in the green. We're seeing headline inflation all across Eurozone decelerate. All right, it came in at 2.4% in March from 2.6 in February. Core inflation over in Europe, which is just like the U.S., you take out food and energy, which tend to be the most volatile. Never going to understand why they don't include that, because people, how are you going to get by without food and energy? But anyway, that came in at 2.9% from the prior month's 3.1. So that's all going in the right direction. Year-over-year increase in services prices came in at 4%. That's the fifth consecutive month of an increase we're seeing in pricing there. And then the S&P Global revised their estimate for the composite PMI index, which includes both services and manufacturing, came in at 50.3 in March. The initial expectation was 49.9. So remember, anything over 50 is expansion, but for all practical purposes, it's flat, right? Anyway, the ECB is kind of putting notes out there that the case for rate reductions was starting to strengthen. Although they're meeting this next week, I don't see them doing a rate reduction, but I can see them teeing it up like the Feds, okay? And then, of course, if we go over to the Asian markets, you see the Nikkei was down 3.37% for the week, but year to date is still very strong, okay? They hinted that another interest rate hike might be on the horizon, all right? 10-year Japanese government bond rose to 77 basis points from 72 basis points the prior week, so that's a good thing. The Bank of Japan governor, he basically said that, and he's been saying this now for months, so it's just I think it drives a lot of the market participants crazy. But he's saying that they could act in any manner at any time to stop the descent of the yen. The yen is like 151 to the dollar, so it hadn't been that low in quite some time. This is the area where the Bank of Japan tends to jump into the market and buy yen and sell dollar, right? Keep in mind the Bank of Japan, just like Europe, just like the Feds, they target about a 2% level of inflation on a sustainable manner. Okay, now they're higher than that now, but if inflation goes much higher, they may have to interject and come in with a rate hike, right? And you'll see the yen love that. Same thing with the government bond over in Japan. Meanwhile, in China, really the only two, China and Hang Seng of Hong Kong, are really the only two indexes that closed in the green this week that we follow, the main ones, okay? March indicators in China kind of reinforced hopes that their economy may start to consolidate and move up. Their manufacturing PMI actually came in at above consensus at 50.8 in March. Last month, or February, it was at 49.1. Anything, again, below 50 is contraction, above is expansion. So for all practical purposes, it's flat. Meanwhile, their non-manufacturing, their services came in at better than expected 53 from 51 in the prior month. So that's showing the consumer is starting to spend a little bit, okay? Now, the People's Bank of China, keep in mind, they are still continuing with stimulus to encourage demand there, right? They want to support their annual growth target of 5%. I think it'll be hard to hit 5%, but China can do things with the numbers that most other countries cannot. Okay. They still have weak consumer confidence, and the real estate market continues to be a huge drag on their economy, right? New home sales slumped year over year 49% in the month of March. So, and remember, most of Japanese or Chinese consumers have their money tied up in property. So when property slumps, consumer spending really goes through the toilet. Okay. So that's a little bit about what I'm seeing there in these markets. Let me just shift the screen over just a little bit, and I am going to show you some key charts. What I'm looking at here, the first thing we're going to look at is the E-mini S&P 500 futures. It'll take about 10 seconds to come up on your screen. And you're going to see this upsloping channel that we finally broke this past week on that really ugly down day on Thursday, okay? We've been inside this channel really since about the second week of January, all year long. There's only been one or two moves below the channel intraday, but we always manage to close inside the channel. You can see the MACD is just well north of zero and running flat. And then we started to move lower, and we finally got that break on Thursday this past week when a couple of the Fed governors threw out the fear of interest rate hikes, not cuts, as a possibility, and interest rate cuts being pushed further out in time. Well, that's all the markets. The markets were just ready to sell off a little bit, and you could see that move lower. And actually, on Thursday, it took out price action going all the way back to the middle of March, right? So on Thursday, April the 4th, we took out all the gains that were made through the middle of March of this prior month, right? And then you could see on Friday, we moved back up, but we didn't really come in where we left off, because on what made Thursday even worse is intraday, it was up around 5,300 and it closed right around 5198, right? For the E-minis. So it was over 100-point intraday move. Um, but when and you could see this candlestick on Friday didn't even come up to the highs made on Thursday. So I think we're going to have some sideways action until we get another important number this coming Wednesday, which is the CPI. Now, the Feds focus on core, not headline, but they do like to see headline and core moving in the same direction. Their other preferred gauge, the PCE, came in okay the prior week. Now, we don't get the PCE again until the end of this month. And that's the other preferred gauge that the Feds follow, personal consumption expenditures. Okay. So where are we going to go from here? Well, you can see I've got pullback points. I've been telling our members, and you too, I believe, on our free weekly roundup, that the month of April and May is where we got the risk. You could see my estimated pullback points calculated by my system. And my system uses a combination of Gann and Fibonacci and prior movement, right? And Elliott wave. Now you put all this together and it's saying anywhere from, let's call it 5,100 down to 5,000. That to me would make sense, okay? And if we just use this measuring tool here, let me just put this on here and do the ruler. And let's just take it down and just kind of see what that means. 5,100 is about 4.41%, little, almost slightly under 5%. And then if we come down to 5,000, it's about 6.2%. So from 5 to 6%. Remember what I said, 4 to 7% makes sense to me before a lot of buyers come in. The 50 EMA is sitting here right at about 51.16, so just slightly more than 4% off the highs. Again, very, very doable. And in fact, on a weekly chart, I don't even think you'd see it on the chart. So the risk is still to the downside, even though we had a good jobs number. We got to see where inflation comes in on Wednesday. And then on Friday of this week, we kick off Q1 earnings. And we do it as we always do now. It used to be another company kicking off earnings, but now we get banks. We're going to get Citi and JP Morgan and Wells Fargo before the markets open on Friday, and then we get a wealth of earnings next week, the week after this coming one. But earnings and inflation. And keep in mind, even though inflation stays higher for longer, sticky for longer, and the Feds keep rates higher for longer, the markets will not care if earnings come in strong, all right? A lot of people think that if inflation stays sticky and the rates stay higher for longer, meaning they don't go up, but they don't go down. As long as we got strong earnings, we'll be good. But that puts a harder bar to cross for earnings. With higher interest rates, it drives profit margins down because consumer spending eventually goes down, which affects profit margins. Okay. So it's a cycle that tends to play itself out over time, and we're getting at that time, the middle of the summer towards the early fall time. We're going to start to see the effects of all this inflation that's coming, or inflation plus high rates coming in. So this is what I'm looking at near term. I'm still saying any move up, be very suspicious of it. I think we have a little bit more downside to go, clearly down to the 50 EMA. Okay, now if we get the sun and the moon and the stars line up and we get good inflation number on Wednesday morning, then we could move up a little bit, but I think you're going to see weakness in the markets. The only thing that's going to keep the markets up and we make new all-time highs over the next 3 weeks or 4 weeks before we get the next Fed meeting on May 1st is going to be earnings, right? Outside of that, and the bar for Q1 earnings is a lot tougher than the bar for Q4 earnings. So just understand that as well. Okay. So that's kind of what I'm seeing here. If we look at NASDAQ, you're going to see NASDAQ also has come out of the upsloping channel. Now, NASDAQ is showing a little bit more weakness than the SPX. In fact, the SPX is leading. It's up 9.11% for the year. NASDAQ's up 8.24. Okay. So we're getting a broadening out of the market, which is a good sign. All right. But again, higher bar for Q1 earnings. We got to see what's going to happen. NASDAQ is coming close already, testing the 50 EMA. Okay. So that is a little bit about where we are with NASDAQ. I think a little bit more downside could be in order for NASDAQ. And again, inflation is going to move these numbers a pretty good little bit, but it's just north of the 50 EMA. 200 EMA is well south. Okay. I do believe that after this short period in April, May, then I think the market's going to move back up. We'll probably make new all-time highs, and then we'll come back down as we get into the tail end of this summer into early fall, and then we'll make another run at it, I believe. That's kind of what things are lining up for, but let's see. Remember, last summer, in 23, the markets were finishing a move lower from August, September, and October, and then we were down in the correction territory, not bear market, but down. 2022 was a bear market. October in 2022 was a bear market low. So we could have a weak summer. So my risk, even though it's April, May, it could extend out to August and September before we have a flourish through the end of the year. All right. So right now we're just in a risky period. All right. Just understand that. And then of course, if we look at the Dow futures, you'll see here the channel is a little bit more flat. It's a little bit more steady, but we also broke the Dow channel as well and actually kissed the 50 EMA and stopped right on it. And then the very next day, we're testing the channel to see if we can get back inside it again. All right. Dow is up intraday high 6.29% for the year. That was on April 1st, and then we've given it all up since then. Right. And that's kind of what's driven volatility. And then, of course, if we look at the worst performer for the year, the Russell, you can see the Russell. I don't have it on a channel, but you could see this upslope and trend line here and the 50 EMA. So I'm using this as more of a support point, which would suggest a little bit more downside, but we're not up that much for the year. Okay. You can see a little bit of a bearish divergence in that high peak made on April 1st. The Russell is up 5.97% intraday, and now it's coming back down to this channel. If it breaks that channel and goes lower, then it's going to probably bring everybody else down as well. Okay. Now, let me just get this here. Let's come down here. If we look at volatility, look at the front month vol skew. The front month vol skew is still in the red. Okay. Now, when the VIX and volatility in the third Tuesday of the month, these things have to equal each other. But until then, you want this in the green, meaning the volatility futures in the front month is higher than the VIX. But right now it's almost flat. So that tells me there is near-term fear. And you would expect that with the inflation numbers coming in this Wednesday. It could create another rocky dance with price action in the middle of this week. Okay. But we're in there. But if we go out into the back month skew, right, which is comparing April and May vol futures, you can see it's moved up, but we're still well in the green, right? It kind of, with the VIX coming up this week, it did move up, but we're still in a backwardation in the back month skew. So again, the markets haven't flipped out. And then if we go to the 2-month, 8-month spread, in this case, comparing May and September volatility futures, again, a little bit of a rain dance to the upside, but still well south of up here. All right. If we get a 2-8 spread where we're in the red, then that means we're probably going to be, more north of 5%. Down to a 10% move in the markets. It's hard to move that 2-8 spread, but if you do get that, then, be ready. Okay. And of course, if we look at treasuries, if we look at the 10-year interest rate right here, you can see that we made new highs this past week on the 3rd, right? And the middle of the week, we were up 14.56% on the interest rate. We took out that key level here, and on Friday, we moved back up with those strong job numbers. Okay. And if we look at the bond market, we look at bonds, that means bonds are lower. Sure enough, they're around the lows for the year, right? Remember, when bonds go down, interest rates go up. And even though you may not trade interest rates or the bond market, you need to follow it very closely. Right now, the good news is credit spreads are very tight, meaning comparing junk to investment grade, the spread, the difference between the two is very tight. That shows me there's a lot of liquidity in the markets. And right now, we're not that concerned about it. When that credit spread between junk and investment grade starts to spread out and widen, now we got issues. We don't have them just yet. Okay. And then, of course, if we look at the dollar, you can see the dollar index had a strong Friday because of strong jobs numbers. We're up near the highs for the year with the dollar. But let me show you the yen. If we look at the yen, folks, we haven't been down this low in quite some time. I'm going to put it on a weekly chart just to show you. Let's go out in time. I mean, way out in time. I don't even know if I can keep it that far. Yep. My chart only goes back to 2001, right after the dot-com bubble. But look at the yen. It's just crashed. Crashed. Now, why is that? Well, a big reason is COVID, and everybody else was putting raising rates. Japanese didn't do that, right? And if you look at this MACD, excuse me, if you look at the MACD here, it's showing bullish divergence. So this is why I like yen long term. That's going to be a long term trade. And you can see we got a pretty solid floor down here. Right here was when the markets thought that the governor of the Bank of Japan, Ueda, was going to raise the rates, and he didn't. So here we came right back down again. So guess what happens when he finally will raise the rates? We're going to have another one of these. So the risk of a bigger move in the yen is upside, not downside. So you want to play upside in the yen. Remember, I'll review that with you this Sunday evening. Okay, and ways to do that. If we look at the euro, you can see with the dollar making near new highs, the euro is holding up right around its 50 and 200 EMA. All right. If we can get some elevation here, I do believe that euro is going to close in the green for the year. We're down around 108, but I do believe the euro is going to move up and the dollar is going to move down as we move through the summer months into fall. So I like the euro or the euro dollar going through the end of this year. And then, of course, let's look at gold. Wow, what a Friday gold had. Look at this. I haven't even had a chance to adjust this yet. Gold, let me put it on a weekly chart for just 1 minute. You can see gold has been in this range here for quite some time, going all the way back really to 2022, 2023, and then finally it just broke out, okay? And if I take it back even further, you can see right in this area right here, going back to 2020, it would peak out around 2050. And then we just broke out of this and poof, we took off, right? Now, I would not chase gold up here. I would buy it on a dip. If we look at it on a daily chart, you can see right over here, right at the end of February, beginning of March, it's just taken off. Now, a lot of this is due to sovereign wealth funds like China and Russia and others going into the market and buying a ton of gold, right? And they are doing that. And with an interest rate projected to come down, not go higher, then that also helps gold. And when interest rates go down, the dollar gets weaker. That also helps gold, okay? So gold is on a tear. So we're going to watch gold. I think there could be some opportunities here on buying the dip. Some of the projections I've seen in gold take us up to 2,600, and that's believable. Remember, we're putting a lot of debt into the U.S. market, so that's part of the other reason why people are picking up gold. Okay, and if we look at silver, silver's the same, right? They're following in the footsteps, right? My target for silver was around 30, 31, but I believe it can go higher. Okay, so these are definitely precious metals that we want to take a look at very closely. And let's look at oil. Oil is leading the way. Here's oil futures. You can see oil futures. Also, I got to adjust this as well. This is going to hurt inflation. It's going to increase gas at the pump. And now I didn't expect oil to get much more than the mid 80s, and now we're sitting at 86. So it's at the limit of where I thought it would be at the close of this year. Right now, some of this is the turmoil going on with Iran, Israel, Hezbollah, Hamas, and then you got Ukraine bombing some of the Russian oil refineries, and then you got the Houthi rebels in the Red Sea. So you throw all this in, and there's probably a $3 a barrel, $2 to $3 a barrel risk premium already factored into oil, right? So oil could keep right on running up. I don't see anything that can stop it, short of things in the global political theater slowing down a little bit, and I certainly don't see that over the summer months. And remember, in the summer months is when the consumers are really going to be in their cars driving, and I think you'll see that just put more demand pressure on oil and gas. And if we look at nat gas, okay, if you look at nat gas, I like it down here. Now, I thought it would come a little bit lower, but it didn't, but it hit close to my target. I think nat gas longer term is going to move higher. Right here is just choppy. There's no trade in my mind in nat gas. All right, everybody, that's kind of where I'm sitting right now. Members, I'll see you this Sunday evening for our weekly market watch at 7 p.m. Have a great day, everybody. Ciao now.